So the next example we're going to illustrate of the next couple of slides will be hiding behind the elephant. Now, as we did obviously in Unit 6, we started off with illustrating the trade strategy, as well as focusing on the key principles that you can expect to see within that strategy, as well as the variations and the locations where that strategy will be most effective. Do bear in mind, obviously, we then will turn our attention to some practical examples, both static as well as obviously practical examples that are live. Now, this trade strategy, to start off with, is predominantly, I would say, a little bit more of a scalper's type strategy. Okay, so it's not really a great strategy for someone that's maybe a bit of a longer term time frame strategy, simply because all hiding behind the elephant is that the elephant is none other than a really large order. So a large order is providing liquidity to the market. We recognize that large order, we jump in front of him, and we look to simply execute and take advantage of that large order holding the market. Now, before I actually illustrate this in terms of variation, well, in fact, let's illustrate it. So what we're going to see, and the best way to depict this is through a couple of prices. So obviously we know these are the X's, and this is the footprint chart. So the market comes down to this price point, and suddenly around price point 80, 81, 79, we see a real pickup in volume. In other words, we have a high volume node. Okay, so really high amount of volume being traded. Now, note that in its own doesn't mean a great deal. However, if we continue to see the market reloading, and this is quite important, so we continue to see a process of reloading, in this case obviously buying absorption, okay, that tells us that someone has got a much bigger order to fill on the buy side than the selling that is currently going on. Now, some of you might think of this as an iceberg. It's exactly what it is. Now, the thing is, identifying an iceberg is one thing, but executing and making money out of it is another thing. So before we actually move on to the variations, let's just talk a little bit about some of the principles that you can expect to see. So obviously we spoke a little bit about balanced and imbalanced auction footprint process. Now, typically, you're going to see this when we do have an imbalanced process. Why? Because this does tend to occur at extremes. So either we extend on the previous day's low, if that's the previous day's low, so we extend on the previous day's low, and then we get an elephant sitting in the market, or maybe we have a very aggressive move in one direction, but it always tends to occur when we are in an imbalanced market context. Now, note, what we will see is a relatively high amount of volume. So you could be seeing just a relative amount of volume as the market sells off, and suddenly the volume will pick up. Why? Because the sellers have found a pocket of liquidity. Now note, this is obviously responsive price behavior. Do note, obviously, this elephant has more to fill. So what you will typically see is that you'll typically see the market or the sellers run into this elephant. They will then potentially extend on the elephant. So a lot of the time you do get an extension of the elephant. Now, it's crucial to get the extension of the elephant because it's this part of the process that ultimately identifies this as hiding behind the elephant. In other words, let's draw it again. So we get our elephant. The market then extends through him. Now, what happens after that extension is extremely important in observing and identifying this trade strategy. Okay, because what you need to see is you need to see that elephant step straight back in and initiate in the opposite direction. In other words, what's happened is he's absorbed at these prices, but he's got more to come sitting below the prices he's absorbing at. Okay, once we get below those prices, he simply initiates in the direction that he's buying. Okay, and that's effectively what hiding behind the elephant is. That is the elephant, but ultimately he's hiding behind his passive reloading. Okay, now in terms of obviously liquidity, as you can see, liquidity is provided. He goes from being a liquidity user. Okay, so note, he's a user in the first example, Sorry, let's take he's a liquidity provider in the first example, as the sellers come down to him, and then he becomes a liquidity user. Okay, so he first provides liquidity and then utilizes. Now, very often these do leave bad lows and highs. Okay, and this is obviously the second variation of the trade strategy. Because we know by definition a bad high or low, as we'll discuss in later in one of the units, a bad low high does tend to extend. Okay, so with that in mind, just briefly touch upon the delta shading. I don't need to mention it. You're going to see a very aggressive, if this isn't a down move, very aggressive red delta, red delta, red delta. If it's an up move, very aggressive blue delta. You'll tend to see probably lighter colors there, maybe even one last price with a dark red, as we said, last bit of absorption, and then you'll see quite a strong light colored reversal. Okay, now in terms of variations, it's very simple. Okay, if the trade strategy is to first observe the elephant, allow the elephant to be broken, and then see if he's hiding behind it, then the trade strategy is very simple. Okay, the first variation, if this is our elephant again, okay, if we break below him, once we get back above the base of that elephant, so if these were a 3 price elephant, once we get back above that price, we're simply looking to execute within those 3 prices. Okay, that is our entry point. We obviously have a stop below the previous extreme, and we're looking for a reversal in the opposite direction. Now note, obviously this is in terms of risk reward, this is not going to be the highest risk reward trade strategy you're going to get. You're simply just looking for a little flush in the opposite direction. Why, you may ask? Well, it's very simple. We know that by definition we've now left a bad high and low. Therefore, that low is quite vulnerable, in which case we don't want to be looking for too big a target. In that case, our second variation is actually the break of hiding behind the elephant. So, if we recognize the hiding behind the elephant, once we do start to turn over and we do get below, for the second time we get below that elephant, we are simply looking to sell for a continuation in the direction of the trend. Okay, those are 2 variations then, and those are our principles applied. Now, let's go have a look at some of the examples on the footprint so we can get a better understanding of what it looks like. Okay, so our first example is in the E-mini S&P. And as you can see, it's quite an obvious elephant. We break below, we can see a nice little double bottom on the low. This was taken from the 19th of December. It is also a rotational chart. Bear in mind, these elephants, you can see equally good on a time-based or a rotational based. Okay, so what we can see, we come down and we get this really big elephant here. Okay, notice the comparison. You know, this is, I always say, and the tip for this trade strategy is ultimately, you know, learn what is large absorption in your specific market, because most people don't. Okay, but if we just do a basic comparison, can you see 13,000 contracts traded anywhere else on this page? Probably not. I think the next best is 7,000 over there, maybe 6,000. So almost double the amount of volume. And that's, you know, if you want to learn this trade strategy and be really good at scalping the elephant, you need to first identify what is relatively high volume. Once you do that, then simply just observing it, noting it. Step 1 is obviously noting the elephant. Step 2, letting the elephant be taken out. And once we get back above that elephant, we want to then look to be a buyer at one of the 4 prices. Okay, we can see obviously the market does give us a fill at 87.25. Comes back a second time, gives us a fill there, comes back a third time, and even comes back a 4th time. Okay, so it does give you multiple opportunities. Do note, like we said, what we do not want to see is we do not want to see the market going below the elephant. So in this instance, obviously, we would have most likely been taking profit on one of these 3 rotations. Time is quite an important factor here. Obviously, because we're expecting initiative in the opposite direction, it shouldn't be taking that long. So what I would say, if this was a normal example and you weren't out, you would have most likely stopped out at that point. Okay, so that's our first example of a hiding behind the elephant. Now let's look at an example of another one in the oil market. Okay, so this is taken from the 20th of November in the oil. Again, note the elephant, and I'm going to show you a practical example of this in a minute. You're going to see what it looks like, how quick it is, but that's the iceberg order. Again, know what is relatively large volume. Okay, 2,100 contracts is extremely large volume for the oil market. Note how the market obviously comes down. It has a look below the elephant, comes back above the elephant, gives us the full opportunity. But note in this example, notice how the market obviously does go back below the elephant, and this is what made this very, very tricky, because it ultimately did go back below the elephant. Now, like I said to you, some of the traders would choose to have their stop below the low. For me, I prefer to keep it much tighter, so I'd like to keep it once it goes back, but I would like to keep it pretty much around where the base of that elephant is. What I will say as a general rule of thumb is when the market does come back off it a second time and retest the elephant, you want to see some speed reversal away from it. Okay, if you see that speed reversal, in that instance, you want to ultimately be placing your stop below the elephant. What made this tricky was ultimately it was the very next rotation in which we came and tested it. So I think that's what made it tricky in this example, but ultimately we can see that the elephant did hold and the market did rotate higher. Okay, just in terms of basic observations, obviously we do note the very aggressive volume, the real pickup in volume and delta, and ultimately the cumulative delta on the day. Okay, now let's look at some one more example before we move on to the practical examples. So ultimately, again, what we can see, this was taken from the 14th of November. Probably not the greatest example, and I'll explain to you why. Okay. What had happened was, and again, this is why relative volume is so important, and why focusing on the delta is so important. So again, some might argue that 600 is quite a large reload order, but ultimately, if you get if you don't identify what is large volume or not, okay, you're not going to become very successful at this trade strategy. So I've put this example as just a random example I've taken from the oil, but what we can see is that it did come back. It retested this, this really dark amount of volume traded here, and then continued to sell off. However, this is not an elephant. Why? Because an elephant needs to be at least bigger than one price. Okay, that's the first thing. And second, you need relatively high volume. Okay, so that's the two real key takeaways from this chart. And just make sure you learn and differentiate between the two. Now, one thing I do want to point out, be very cautious. Okay, be very, very cautious trading this strategy in roll week. Okay, in fact, don't even bother with this trade strategy. Why? Because contracts are rolling. You're going to see a lot of potential elephants, and a lot of them are actually not elephants. They just simply roll. So just bear that in mind. Also, things like OPEX. Things like month end, be cautious trading them. So as I mentioned, you're going to find this as extremes, at the break of extremes, and you will see this as we go through examples. You will see what this looks like on the ladder in a minute. In terms of entry, I think the best thing to do is to go back to the previous example. As I mentioned, we're looking for an entry point somewhere within that original elephant, and with a stop either below the elephant or below the previous low. Okay, let's now go and have a look at two of the practical examples and see what they look like. Okay, so let's take a look at an example of the elephant. What you can see in front of you on the screen, between price point 80, 81, 82, we can see a real aggressive relative amount of volume being traded. Okay, so again, like I said, you can see almost a good 2,000 in this case, 2,600 contracts traded at 81s. A real elephant sat in the market providing liquidity. Now the market comes below the elephant, and you'll see once it comes back up above the elephant, this is the thing, is that the price response will be potentially slow below the elephant, but once it comes back up above the elephant, you should see it reverse quite quickly in the opposite direction. Now, before I move on, and I'm going to keep letting this play, in terms of targets, I think this is what's so wonderful about this whole course. A lot of the principles you've learned are gonna aid you in determining targets and stops and all that, but we can very clearly see, note the imbalances up above. Okay, we can see a little bit of stop outs, we can see a real amount of imbalances. So for me, in terms of a target, I'd be looking for at least a fill back up towards this, double O's, maybe 01s, 02. So, we've got a good 20, 22 tick target here, and it's not going to cost us a great deal. Now, obviously, I mentioned in terms of stop, either you want it just below the elephant or below the low. So again, if you're looking for a 20 tick target, you could probably afford to take maybe a 6 tick stop. Whereas if you're only looking for, say, a 5-6 tick target, you might want to keep your target a little bit tighter. Okay, so we can see obviously the market's now come back above those 81s. And again, what you're going to see now is we can see on the price ladder as well, but you can see now how the market's gone from being aggressively selling to suddenly more of an initiative in the opposite direction. Okay, note obviously in terms of execution, what we're looking for is we're looking for a retest of the elephant. Once the elephant is retested, as we can see here, all the way down to 80s. Okay, this would have been a good opportunity, 81s. Note the absorption. Okay, so if you want to get a 1 lot or a 10 lot away, you'll easily be able to get filled in there. Note the market did break below, but ultimately did come back. But now, we spoke about in terms of the second variation of the strategy, what you would expect to see. And again, this is where, again, I try to give you guys as many variations, but always try to give you caution. If you're going to go with the 2 variations, you would have been a seller below 80s, looking for continuation with a tight stop, so maybe somewhere around 85s. If you believe firmly in the elephant, ultimately you'd still be long with a stop below the low. So it all depends on the variation you're applying. There's no right or wrong, guys. It's about you evaluating the strategy, understanding the strategy, learning the strategy, and then applying it. So let's just go through it. Obviously, we can see the second time we came back above the elephant. Market then rotated quite nicely towards the upside, and ultimately we eventually went and filled out the imbalance to the upside. Okay, and obviously one last thing, do note the bad low. We will talk about this strategy a little bit later on, but do note the bad low there. You can see the market's traded almost 200 odd 229 contracts, or more like 260 or 275, apologies, and bad low, so we know there's a high probability for that to be taken out later on. Okay, so that's our first example. Now the second example is what happens when we get it wrong. What happens when we don't identify an elephant and we simply just getting sucked in? Remember I said the rules? You do want to see obviously at least more than one amount of absorption. You need to know what is high relative absorption. So I'm just going to show you the example of the picture we saw. So what you're going to see now is the market comes down to the 600 lot. I want you to see how the 600 lot trades. What you can see is on the price ladder, it is one order. Okay, so we can see on the price ladder here, it was just simply one order wanting liquidity there. It wasn't an elephant per se. Why? Because an elephant or an iceberg will tend to not show the whole order. He will ultimately tend to look to fill it up, and not show the market the entire order. Okay, so we can see obviously, the orders all got filled on the way down. Market came back up, and then the market continued low. So this is again this is what an elephant doesn't look like, and I think that's the importance of showing this video. Just make sure that you follow the rules for identifying and observing an elephant. Alright guys, we're going to move on now, and we're going to go complete the template together. I'm going to go through all the key observations, strategy identifications, and execution principles in the slides ahead.